Everyone. So we are going to talk about economics today, and in CFA Level 1, as you may already know, economics accounts for 8 to 12% of the overall topic weightage, which would mean that you will get questions in the exam up to 8% of the total number of questions, as low as 8%, as high as 12%. So let's take an average. A midpoint average is like about 10%. So I can say that, altogether you will have a total number of questions of 180 questions in both sessions, the first session and second session put together. You're going to have altogether 180 questions, 90 questions each, and 10% of that 180 translates into 18 questions approximately. It's not a guarantee because there is a range of 8 to 12%. So what I would like to see is you would have questions anywhere between 18 questions is a good ballpark figure that you can think of. So you're going to have 18 questions on the overall exam. So that tells you this is a very important topic in CFA Level 1. So what I'm going to do today is that I'm going to just do an introductory session on economics, so that these, I call them kind of a refresher or preparatory slides, whatever the way you want to call it. Let's spend about 30 to 45 minutes on understanding what economics is all about before we dive deep into CFA curriculum on economics. So that's what I'm going to do. I'm going to start talking about economics broadly, what it is and what are the things that you need to know about. So that's kind of a refresher before we kick start with CFA Level 1 portion. So let's get going here. So we're going to talk about introductory. We need to understand what is economics, and here you go. Right, so hope you can see my screen. Hi everyone. Here you go. So these are preparatory slides. We are going to spend the first 45 minutes in understanding what economics, what are the terms that you need to be familiar with before we dive deep into CFA curriculum. So before getting into details, the first question is, what is economics and what are we going to talk about? Remember, economics is a social science. So what do you mean by a social science? There are many social sciences available, but economics is one of the major ones among all the social sciences. So what economics does is it analyzes the fundamental economic problem of scarcity. Scarcity is the fundamental economic problem. So we need to understand what is the meaning of scarcity. Scarcity is basically, shortage of resources, meaning that, the resources are used to produce goods and services, and such resources are available in limited quantities, but humans' needs and wants are unlimited. So what the society is trying to do, what are we trying to deal with on a day-to-day basis, whether it could be at, at your home, it could be at individual level, at household level, or at an organization level, or at national level in a country. The issue is scarcity, meaning you are trying to deal with unlimited needs with limited resources. You only got limited resources, but you got unlimited needs to satisfy using the limited resources. So that is the problem of scarcity, and economics tries to analyze, identify the problem of scarcity and explains how individuals and societies and governments try to deal with this problem of scarcity using a scientific approach. Because of the scientific approach, we call economics is a social science. So basically move on to the next slide. You need to understand what these resources we are talking about. There are 4 types of resources that are used in economics. We call them land, labor, capital, and entrepreneurship. I mean, you call them factors of production or you call them resources, but remember they are used to produce goods and services. And this is what we said, the problem of scarcity, because these resources, factors of production, are available in limited quantities. They are not unlimited, but the human needs are unlimited. So when you are trying to satisfy unlimited human needs using limited resources, we encounter a problem of scarcity. And that is what economics tries to sort out, solve, analyze, and come to conclusions and build theories. And that's what we are going to study today in a topic area called economics. So fundamentally, you need to be aware of these resources, factors of production, land, labor, capital, and entrepreneurship. You need to understand what each of them means. Land in economics is all the natural resources used in the production of goods and services. What they could be soil, fish, oil, waterfall, or agricultural land are very good example of land. And the reward for land, in the sense, the cost of land, if somebody wants to make use of land, the cost for that is rent. And then moving on to labor, it's easy thing to understand. Labor is the physical and mental human effort, which is the human capital, human resources. We know about them. The reward for that is salaries or wages. And then capital, there is always a confusion between land and capital. So you've got to be careful here. When you say capital in economics, we are talking about fixed assets, investments into capital expenditure, capital investments like machineries, vehicles, equipments, buildings, and factories. You've got to remember, a bare agricultural land might qualify as a land in economics, but if you turn them into a building, that goes into capital. And the reward for capital or cost of capital, you know about cost of capital. Cost of capital is the interest. So because you borrow money to invest into these capital assets, and that's the reward, the opportunity cost of investing into fixed assets is the foregone opportunity cost. So that's when we say interest. So you have land, rent, labor, wages, capital, interest, and then finally entrepreneurship. So entrepreneurship is the owner of a business who undertakes the risk of doing the business, because he is not going to have a guaranteed profit. You might encounter losses in a business. So in order to compensate an entrepreneur for taking risks in a business, we compensate him with profits. So you got to remember, this is very important. Before we move into the CFA curriculum, you should understand in economics, the factors of production includes entrepreneurship. So cost of production also includes profits. Now, this might be confusing. From an accounting perspective or from a finance perspective, profits is the bottom line. This is the final figure in your income statement, and this is why organizations work very hard to increase the profitability. But in economics, the cost of production also includes profits. What does that mean? If you are running a business and if you ask what is the total cost of running a business, you can say, I will have to pay rent, I'll have to pay salaries to my staff, I'll have to pay interest, and I need something for myself. Why I need something for myself? Because I need to take the risk and I'm running this business. So I'm going to take some profits out. And that profit that I usually expect to achieve is what we call entrepreneurship. And that's what we call profits. That's a reward for entrepreneurship, and that's what we call profits. So in economics, you've got to remember that cost of production includes profits for entrepreneurs. So you've got to understand factors of production, a land, labor, capital, entrepreneurship, with the cost of production or rewards for them are rent, wages, interest, and profits. Moving further into slide 4, I think this sets the scene for rest of our discussions in economics, is because we are actually going to talk about economics, and we are going to divide them into two categories, microeconomics and macroeconomics. And in CFA Level 1, we pretty much cover basic aspects of micro as well as macroeconomics. We will start off with micro, and in the second half, we will move on to macroeconomics. So before getting into that, we need to understand what is the meaning of micro and what is the meaning of macroeconomics, what constitutes each of them. Microeconomics is a study about individual components of a country or an economy. If you take economy at large, you have, so many components which put together to form an economy. There are so many individuals, the total population, and then the total production of goods and services. If you put them together, then you get GDP, gross domestic production. That's your economic size. The size of your economy is what we call GDP, and that's at the national level. That's a macroeconomics. But if you are specifically talking about an individual, you're talking about a specific product, you're talking about a specific firm, you are trying to analyze the micro component in an economy. We are not talking about economy at large. We are not talking about GDP. We are not talking about unemployment rate. We are not talking about inflation. We are talking about a specific product, the price movements, a specific individual, his behavior. Those things are what we call microeconomics. So microeconomics is about price, demand relationship of a product, behavior of an individual, and his spending pattern, cost of a firm. Because it's a single firm, that becomes microeconomics. And then we move on to macroeconomics, where we are talking about a broader economy. It's a study about GDP, unemployment, inflation, and money supply, monetary policy, fiscal policy, all sort of things at a broader level. So what we are going to talk about in CFA Level 1, first we are going to focus on microeconomics and then move on to macroeconomics at the second half. Moving further down, some more slides explaining the basic demand supply functions. So it's very important that you understand in economics, to understand both micro and macroeconomics, we need to understand what is the meaning of demand and supply. In an open market, the demand and supply determines the price. Okay, let's talk about it. What do you think about the relationship between demand and prices? What do you think about it? If the prices go up, if the demand increases for a particular product, what do you think is going to happen to the price? What do you think is going to happen to the price? When the demand increases, I'm not talking about the relationship between price and demand. We are actually talking about the relationship between demand and price, meaning that when the demand increases for a product, and if you think the supply remains unchanged, the price tends to go up. So what drives price is the demand. But on the other hand, you think that the supply is more, supply keeps increasing. What do you think is going to happen to the price? What do you think would happen to the price if supply increases? When the supply increases, price go down, and this is exactly what happens to the oil prices. If you understand the oil price dynamics, you would understand the problem of oversupply particularly well. What do you mean by oversupply? In the sense, if you think about the oil markets, the problem is that there is excess capacity, there is excess supply, because these oil producing nations add more capacity, more production, but on the other hand, the demand for oil is going up less than the supply is. So that creates an oversupply situation. Oil prices has been facing difficulties and prices has been falling. And you could actually see what happened during the pandemic. Last year, what happened, there was a huge drop in demand for oil, because as you know, 1/3 of the crude oil demand is created by the travel industry. During the lockdown, when the travel industry was particularly down and aircrafts grounded, the demand for oil came down significantly. And on the other hand, you know, Russia and Saudi got involved in a oil price war, which reduced the prices of oil more. So there was a double whammy. On one side, the demand was going down. On the other side, the supply was going up with, you know, the price war that happened between certain nations in the Gulf region. So as a result, what happened? The oil prices went down. And in the United States, I'm sure you guys know, the oil price futures went into negative territory. So again, what we are trying to say here is that the relationship between demand and price, meaning higher the demand, price increases, lower the demand, price decreases. On the other hand, higher the supply, demand decreases, and lower the supply, demand increases on a given day. If there is not enough supply, so what happens to the prices? Prices go up. Think about what happened to the prices of masks and what happened to the prices of hand sanitizers during the early phase of pandemic. They significantly went up because there was shortage of those products. More demand, less supply. So if the supply is less, demand is more, prices tend to go up. But if there is excess supply, but the demand is less, prices tend to go down. So this is something that you need to understand. It is the demand and supply which determine the price, which in turn determines the profitability of a particular industry and thereby a firm. Okay, in this particular topic, demand curve, we are going to talk about the relationship between price and demand, which is more simple, isn't it? I mean, we know what happens when the price of a product goes up, the demand drops, and when the price drops, demand increases. So which is a negative relationship between price and quantity demanded, because people want to maximize the utility of a product, which would mean we would buy a product more when the price is lower, and we would buy them less when the price is more. So there's a negative relationship between price and quantity demanded, and that's what we are talking about in a downward sloping demand curve. So what is the meaning of law of demand? A law of demand talks about the relationship between price and demand. What happens when the prices go up? Demand drops. When prices drop, demand go up. There is an inverse relationship between price and quantity demanded, and that is what we call law of demand. Moving further down, what we are going to talk about here we are going to talk about what are the factors influencing demand of a product. So this is exactly what we're going to talk about here. What factors would have an impact on demand of a product? Can we talk about it? The first one, price of a product would have an impact on demand. Higher the price is lower the demand, lower the price is higher the demand. So that's the relationship between price and quantity demanded. You got to understand something. The factors influencing demand of a product, usually we divide them into two categories. One is price and non-price factors. So from Item number 2 until the end are non-price factors, and the first one is a price. Price of a product would have an impact on the demand for that particular product, and there are other factors that you need to take into account. For example, price of a substitute product. So what is a substitute product? Is a product that can be used instead of another, replacing another product. So good example that we always talk about is, what is the most popular example of substitute product is tea and coffee, is you consume one instead of another. So this that's what we call substitute products. And you need to think about what would be the relationship between price of substitute products and the demand for a particular product. Think about, let's say we are talking about tea, factors impacting demand for a product. Let's say that product is tea and coffee is a substitute product. So what happens when the price of coffee increases? What happens to the demand of tea? Tea for demand will go up. Demand for tea is going to go up. That's exactly right. When the price of coffee increases, tea of demand increases. So what we can say, there is a positive relationship between price of one product and demand of another product in the context of substitutes. Then let's move on to the next one. Think about complementary products. So what do you mean by complementary products? Two products together should be used together to achieve a specific utility. So what can we talk about? Again, you know, if you take tea as an example, you talk about sweeteners, sweetener, sugar, or any other form of sweeteners that you use are complementary products. So what happens when the demand for sweetness, price for sweetness increase, means what would happen to the demand for tea comes down. So there is a negative relationship between price of one product and the demand of a complementary product. That's exactly right. So there's a positive relationship between price of one product and the demand of a substitute product, and there is a negative relationship between price of a complementary product and demand of a specific product. So that needs to be understood. I'm telling you this is very important because there is something in level 1 curriculum. We talk about cross elasticity of demand, which bases its logic on these two items. Moving on to income level of consumers. So higher the income, higher the demand, lower the income, lower the demand in terms of purchasing power of individuals. So as income increases, purchasing power increases, income decreases, purchasing power decreases. Unemployment rate, how do you think that's going to have an impact on the demand? If the unemployment rate is higher, that's going to reduce the demand. That's exactly right. Lower the unemployment rate, higher the demand for a specific product. Consumer preferences, taste, various things can have an impact on the demand of a product. For example, if you think globally, we see a positive trend that there has been a reduction in the tobacco consumption over the last decade or so. That is due to the negative health advisory and negative health advisory by various bodies, and that had a positive impact on overall consumption of tobacco. And that's where we talk about the consumer preferences due to changing trends and changing tastes and preferences. There have been increase or decrease in demand for various products. And we also see there has been a significant increase on demand for organic produce, again, based on the same logic of consumer preferences and health advisory and various factors. So that's an important factor that needs to be understood. The last one, future expectation of price changes of a product. If you expect price of a product is going to go up in the future, what do you think is going to happen to the demand for that particular product? Can we talk about it? If you expect price of a product is expected to go up in the future, the demand currently is going to go up because people try to you build inventories because now the prices are lower. And this is typically seen in countries where the government announces the fuel prices are going to go up starting from a future date. In a couple of days, you see people queuing up in petrol stations to fill up their tanks. So that's very important for you to remember, and these are the factors having an impact on the demand of a product. And also remember that this is not the exhaustive list. There's a lot of other things can come up, but this broadly covers most of the things. Right. So, and a great example someone has pointed out here is that demand for household items increased before the lockdowns on fears that there will be a continuous lockdown. So people wanted to stock up. Yeah, that's again a great example how an external factor or future expectation can have an impact on demand of a product. Moving further down, so this is going to be important discussion for us because we are going to talk about normal goods, and we are also going to talk about certain exceptional goods where there could be positive relationship between price and demand. What do we normally say? There is a negative relationship between price and demand, isn't it? When the price goes up, people reduce demand. When the price drops, people buy more and increase demand. That's applicable for normal goods. But we also talk about here, we also talk about given goods. What are given goods? Given goods are certain inferior products consumed by, poorer people in a particular region is what we call given goods. So now you can ask me how this name came up. Giffen is an economist, and he did a research on a particular segment who basically are on the poorer segment of a particular society, and he basically did a research analyzing their behavioral pattern for an increase and decrease of prices of these given goods. So these given goods, how he defined as the goods which are inferior to the normal products. It's a good example that you can talk about. Maybe bread is a good example of an inferior product which can come into as a given goods. What this economist argued, or what he observed, when the price of given goods increased, the demand for given goods increased. When price for given goods decreased, the demand for given goods decreased because people will now have more ability to buy good quality products. So you reduce the demand for given goods when the price goes down because you now have more ability, your purchasing power increases. You will be able to buy better quality goods. So that's something that you need to understand. Exceptional demand for given goods where there is a positive relationship between price and quantity demanded, contrary to what we have been talking about. Right. So this is what something that you need to know. There is a negative relationship between price and quantity demanded for normal goods, but for given goods, it works on the opposite direction. Positive relationship between price and quantity demanded for inferior goods, simply because when the price of given goods decrease, the purchasing power of consumers will increase, creating more demand for such type of goods. So there's a question to give example of a given good. So I think I'll give you, let's work out an example and see how that works. So let's talk about, let's talk about a particular employee works in a production factory on a daily basis. And let's say his income on a daily basis, his daily income is, let's say, $10. $10 is what his daily income, and this is the income that he needs to use to feed his family. So what he does is, let's say, he buys now, let's say, 5 units of bread, and each $2 each, and his total income is $10. So this is what he does now. So we're talking about bread here. Now let's talk about what happens now. So he spends the whole of his money on buying the bread. So that's what happens, because that's how we understand inferior product. Inferior products are products consumed by people who are below the poverty line. That's another way to understand what given goods are. Okay, now let's say what happens is that, let's say now the price of bread drops. So what happens? Let's say the price of bread drops to $1. So now what's going to happen is that price of bread drops to $1. So now what he could probably do is, he could probably buy 3 units of bread. So that's going to cost him. How much that's going to cost him? If he buys 3 units of bread, and for each $1, that's actually going to cost him $3. Is that right? So that's going to cost him $3. So how much money he's left with on his daily wages that he earns in the factory? How much money that he's going to have now? So that's going to be 1 times $1 times 3. So $7. He got $7 in his hand. So he can use that $7, maybe buy, pizza, or anything that you consider a normal product in your society or in wherever you live, anything that you consider, because now you've got more money with you, which you can use to buy a good quality product. Because earlier you had to buy 5 units of bread to feed your family. Now things have changed. You got the price of the given good, bread, dropped to $1. So you don't want 5 anymore, because you're thinking you can buy something better. So what you do, you buy 3 units of this, and for the balance $7, you buy something good. You buy some fruits, you buy some vegetables, or you buy something that you consider normal. So this is what we say. So see what's happening. The price of given good dropped and the demand dropped. But what happened when the price of the given goods increases? People are forced to buy more of the inferior products, more of the given goods. So that's exactly what happens. And this is what we're talking about. Positive relationship between price and quantity demanded of a given product. So let's now go back to the slides. Here you go. Right, so now when you talk about law of demand and given goods, so given goods, you need to know that the law of demand doesn't work. It's exceptional demand. So this is what diagrammatically we can show. For normal goods, the relationship between price and quantity demanded is negative. So we talk about downward sloping demand curve. See what happens, the price increases. What happens to the demand? Demand decreases, and price decreases from P2 to P3, and demand increases from Q2 to Q3. See what happens. And See what happens to different goods. The demand curve is upward sloping, meaning that when the price increases, demand increases. Price decreases, demand decreases. So that's something that you need to understand here on law of demand in different goods. Moving further down, what you need to understand is on slide 10, we need to understand the difference between movement along the demand curve and movement of the demand curve. So what is the meaning of this? As we spoke about factors influencing demand of a product, we categorize the factors into two. We said price, and then all the other factors we said non-price factors. So what happens is, if you look at this graph, the first chart, this we said movement along the demand curve, which means the demand curve does not shift to the right or does not shift to the left. It stays as it is. But you see movement along the demand curve. So see what happens when the price of a product increases, demand for the product decreases. So what happens? Previously, the price and demand were meeting at this point called B. And when the price increases, the demand decreased. So the point shifted from B to A. So what happened? The demand curve does not shift, but there are changes within the demand curve. Sometimes we call them demand extension and demand contraction. So what is the demand extension? Is when prices drop, demand increases, is demand extension. Demand contraction is price increases, demand decreases, that is the demand contraction. So only the points in a demand curve will change, but there are no changes in the demand curves. Look at this, what's happening here? Here, we are actually talking about changes in the demand curve. Either the demand curve is going to shift to the right or the demand curve is going to shift to the left. So this is where non-price factors are going to change. Price is not changing, but other factors are changing. For example, income of an individual increases. What happens to the demand? Can we talk about it? Income of an individual increases. What happens to the demand? Increase in income, demand increases. That's exactly right. Higher the demand, higher the price, higher the income, higher the demand. So what happens here? Price doesn't change because price is not changing, but other factors are changing, which can increase the demand or it can decrease the demand. You can afford more and you have more purchasing power, so the demand is increasing. But if the income decreases, it decreases. Not just the income, any factors. For example, price of coffee increases. We are actually talking about price of coffee and the demand of coffee. But think about any other products. For example, price of tea. If the price of tea increases, what happens to demand for coffee? Demand for coffee increases, so the curve shifts to the right because it is a non-price factor. Price of a substitute product increases, the demand for coffee increases. This is called increase in demand. The demand curve will shift to the right. And if there is a decrease in demand, the demand curve will shift to the left. But what is causing that? What is causing that is not the price of a product. It's caused by any other factors other than the price. And that's why we are keeping price unchanged. Now, you can raise a question. Now, how do we diagrammatically show when the price of a product is changing, income is changing, so many factors are changing? But remember, in economics, in short term, we assume only one factor changes at a time. So you got to remember that always. In economics, short term, is a situation in demand theory, only one factor changes at a time. So if the price changes, other factors does not change. When other factors do change, price does not change. If not, the effect is going to be mixed. So it's very difficult for you to show them when the price of a product increases, demand decreases. But think about price increases, but income also increases. What happens? Price increase will decrease the demand, but income increase will increase the demand. So it's like a mixed bag. There is an offsetting impact, which we are not trying to show here. We are trying to make things simple in economics, and that's why we say it is short term. All these graphs are done in short term. So short term in economics, remember, it's not defined by number of years or time period. It's based on how many factors do change. In short term, in demand theory, we say only one factor determining the demand of a product is going to change. If price change, other factors do not change. If one of the other factors changes, price does not change. Okay. That's about increase in demand, decrease in demand, shifts in the demand curve, and movement along the demand curve. Now we are going to touch base a little bit on the supply. So we spoke about price-demand relationship, and we said usually the demand between price and goods and services is negative, because when the price increases, demand decreases, price decreases, demand increases, negative relationship. But we also said for given goods, there is an exceptional demand, and there is also something called Veblen goods. Have you heard about Veblen? Veblen goods. Anyone has heard about Veblen goods? What are Veblen goods? Again, the demand between price and quantity demanded is positive. So what are Veblen goods? I mean, think about certain luxury cars, like let's say BMW, or talk about Mercedes. What happens when the price increases, the demand increases, because we are talking about a market which is not really price conscious, which is not really price sensitive. And we are talking about a market where people think high priced products are good quality ones, or I mean, where the products are based on, the demand for the products is based on image or your prestige. So you want to buy something expensive to show the rest of the world that you are using the most expensive car in the world. So that's what Veblen. So for Veblen, what happens when the price increases, demand increases, because people will buy more because they think that we want high price products. So again, there is exceptional demand. So you should understand, in demand theory, exceptional demand can come in for given goods as well as Veblen. Now, we are talking about supply theory. So what do you think about supply theory? What do you think is generally the relationship between price and supply? We are thinking from supplier's perspective, the people who manufacture the products. So they behave different to the buyers who create the demand. Buyers create the demand. Who create the supply? The sellers create the supply. So if you understand the behavioral differences between buyers and sellers, you would easily understand the differences between demand and supply. So when the price increases, what happens to the supply? The supply increases as sellers are motivated to sell more at a higher profits. And when the prices drop, sellers are demotivated, so they produce less. So there is a positive relationship between price and quantity supplied. So moving further down, we are going to talk about what factors would have an impact on the supply of a product. So these are the factors that are going to have an impact on the supply of a product, price of a product. So what happens? What is the relationship? Is the relationship positive or negative? Can you guys talk about it? What do you think is the relationship between price of a product and the supply of the product? Positive. When price goes up, supply increases. Price decreases, supply decreases, because we are talking about profit motivated sellers and how they behave. Cost of production. If the cost of production increases, what do you think will happen to your supply? Higher the cost of production, what do you think is going to happen to your supply? Your supply is actually going to drop. Why the supply is going to drop? Because the profits are going to be lower with higher cost of production, so that sellers are demotivated to produce more. So higher the cost of production, lower the supply, lower the cost of production, higher the supply. Change in technology. Positive change will increase the supply, negative change will decrease the supply. Government policies, taxation and subsidies, this will have a major role on the supply of goods and services. Why? When the government increases the taxation in the economy, what happens to the supply? The supply decreases. But when government provides more grants and subsidies to help the businesses, the supply increases. Price of related products, think about byproducts. What are byproducts? When you kind of produce a product and you have a byproduct together with that product gets produced. If you think about oil industries, oil and gas industries, petrochemicals, there are certain chemicals that are manufactured by these oil and gas companies, are a great example of byproducts. So what happens when the price of byproducts increases? Producers are motivated to produce more because they can get more byproducts and sell them at higher prices. So you need to think from the perspective of sellers whose primary motive is profit maximization. And if you think about buyers who create demand, the primary focus is utility maximization, value maximization. So that's when we say when price is lower, demand is higher. But here, when the price is higher, demand is higher because your motivation is profits. Now, increase in production capacity, higher the production capacity, higher the supply, and vice versa. Increase in the number of suppliers in the market would have a positive impact on the supply in the market. So again, you need to understand these factors can be classified into price and other factors. So these are the other factors which can have an impact on the demand, on the supply of a product. So any factors of price is changing, there will be changes along the demand curve. You see this, again, we are talking about movement along the demand curve, and then we are going to talk about changes in the supply curve. So what happens when the price increases? Supply increases. Price decreases, supply decreases. The positive relationship between price and demand, and the changes happens in the supply curve itself. What happens when the price increases from P2 to P1? Supply increases from Q2 to Q1. Similarly, when the price drops from P2 to P3, supply drops from Q2 to Q3. So this is what we call supply extension and supply contraction, changes in the price. But when the price doesn't change, when the price doesn't change, what can cause supply to increase or decrease? Can you answer this question? When the price doesn't change, what factors can cause an increase in supply or decrease in supply? What are those factors, and how do we generally classify those factors into? We classify those factors into price factors or non-price factors. What do you think they are? Are they price factors or non-price factors? They are non-price factors. They are non-price factors. Technology is changing, cost of production is changing, taxes are changing. Is that going to be movement along the supply curve or changes in the supply curve? What do you think they are? They are going to be changes in the supply curve because the price doesn't change, but other factors are changing. So the supply curve will either shift to the right when factors change positively, increasing the supply. If those factors change negatively, the supply will decrease and supply curve will shift to the left. And again, this is the law of supply. We talk about a positive relationship between price and quantity supply because the objective of suppliers is profit maximization. So that's pretty much what I wanted to say as part of the introduction. And this is a very important slide. The last slide on the introductory slides is CFA Level I topic coverage. And this is exactly what we are going to talk about in microeconomics and then in macroeconomics. In microeconomics, we are going to start talking about today elasticity of demand. There are three types of elasticity of demand: price elasticity of demand, income elasticity of demand, cross elasticity of demand. Demand and supply analysis, we're going to talk about related factors of demand and supply, and then we are going to talk about the most interesting market structures. What are the different markets available? Perfect competition, monopoly, duopoly, oligopoly, monopolistic, different type of market structures, and what are the characteristics of those structures, things like that. They are very frequently tested in the CFA exams. So we talk about these three areas, and that sums up microeconomics in CFA Level I. Moving into Level 2, moving into second half, we are talking about macroeconomics, where we're going to talk about aggregate output, which is GDP, inflation, economic growth, business cycles like recession and boom, and unemployment, inflation, monetary policies implemented by central banks, fiscal policies implemented by the governments, international trade. We're going to talk about trade protection activities of the governments to protect the domestic infant industries. We also talk about currency exchange rates and the exchange rate regimes available in the market. So that's pretty much all what is on the plate for us to talk about in the second half. So what I'm going to do today is I'm going to give you early break. Typically we do at 6 p.m. local time, but then what I'm going to do today is that I'm going to give you a break now for about 15 minutes. So we exactly start in 15 minutes, which is at the moment the local time is 5:33 p.m. and we start at 5:45 p.m. So be on time. We have a lot to cover in the second half. Okay, guys, thank you.